Introduction to Fundamental Analysis. Fundamental analysis is a method used by investors and analysts to evaluate a company's financial health and intrinsic value. It involves studying financial statements, ratios, and economic indicators to assess whether a stock is overvalued or undervalued. This approach is grounded in the belief that a company's true worth can be determined by analyzing its assets, liabilities, revenues, expenses, and profitability. Below are essential financial terms and metrics frequently used in fundamental analysis. Key financial terms and definitions. 1. Current assets. Definition: assets that are expected to be converted into cash or used up within 1 year. Examples: cash, accounts receivable, inventory. Purpose indicates a company's short-term financial health and liquidity. Similar terms used in disclosures. Short-term assets. Liquid assets. Current resources. Operating assets. Assets realizable within 1 year. 2. Current liabilities. Definition: obligations a company needs to pay within 1 year. Examples: accounts payable, short-term loans, accrued expenses. Purpose: helps assess how well the company can cover short-term debts with short-term assets. Similar terms used in disclosures. Short-term liabilities. Current obligations. Payables due within 1 year. Operating liabilities. Near-term debts. 3. Total assets. Definition: the sum of everything a company owns, both current and non-current. Examples: property, equipment, cash, inventory, investments. Purpose: measures the size and strength of a company's asset base. Similar terms used in disclosures. Total reported assets. Aggregate assets. Sum of assets. Consolidated assets. Gross assets, sometimes used before deducting liabilities. 4. Total liabilities. Definition: the total amount of money a company owes to creditors, both short-term and long-term. Purpose: used to evaluate financial leverage and debt risk. Similar terms used in disclosures. Aggregate liabilities. Consolidated liabilities. Total debt and liabilities. Total obligations. Total liabilities and provisions, IFRS context. 5. Gross revenue. Definition: the total sales or revenue generated before any costs or expenses are deducted. Purpose: a top-line indicator of the company's ability to generate sales. Similar terms used in disclosures. Total revenue. Sales revenue. Turnover, common in UK/IFRS. Operating revenue. Top-line revenue. Revenue from contracts with customers, IFRS 15. 6. Gross expense. Definition: total operating costs before taxes and interest, including cost of goods sold, wages, rent, etc. Purpose: helps in identifying cost management efficiency. Similar terms used in disclosures. Total operating expenses, operating costs. Total expenses incurred. Direct costs plus operating expenses. Cost of revenue plus SG&A. Total outflows, less commonly. 7. Income/loss before tax. Definition: earnings before tax expenses are applied. Also known as EBT, earnings before taxes. Purpose: indicates a company's profitability from operations before government obligations. Similar terms used in disclosures. Earnings before tax, EBT. Profit before tax, PBT. Pre-tax income. Income before provision for income taxes. Operating profit before tax, if operating income context. 9. Net income/loss after tax. Common variations. Net profit/net loss. Profit after tax, PAT. Net earnings. Bottom line. Comprehensive income. Net results. 10. Earnings per share, EPS. Definition: the portion of a company's profit allocated to each outstanding share of stock. Purpose: a critical indicator of company profitability and a key input for valuation ratios like PE. 11. Price-to-earnings ratio, PE. Definition: a valuation ratio that compares a company's current share price to its earnings per share. Purpose: indicates how much investors are willing to pay for each dollar of earnings. High PE may suggest growth expectations, low PE might imply undervaluation or low growth. 12. Price/earnings to growth, PG ratio. Definition: an enhanced version of the PE ratio that also considers the company's earnings growth rate. Purpose: helps determine if a stock is overvalued or undervalued relative to its growth potential. 12. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Definition: EBITDA is a financial metric that measures a company's operating performance by focusing on the earnings generated from core business operations, excluding the effects of financing decisions, tax environments, and accounting practices related to depreciation and amortization. Key focus areas for investors in financial statements. When performing fundamental analysis, investors commonly focus on three crucial comparisons that provide insights into a company's financial strength, operational efficiency, and profitability. 1. Current assets versus current liabilities. Investors assess whether current assets exceed current liabilities, which indicates a company's ability to meet short-term obligations. A positive working capital position suggests healthy liquidity and operational efficiency during the reporting period. This is particularly important for evaluating a company's short-term financial health. Total assets versus total liabilities. This comparison highlights the company's overall financial stability and leverage. When total assets significantly exceed total liabilities, it signals that the company is well capitalized and potentially less exposed to financial distress. Investors prefer firms with a strong asset base relative to their debts, as it reflects long-term sustainability. Gross revenue versus earnings per share, EPS. Analyzing the relationship between gross revenue and earnings per share helps investors evaluate profitability trends. Ideally, both metrics should show consistent year-over-year growth. Increasing gross revenue alongside rising EPS suggests that the company is not only generating more sales but is also efficiently converting those revenues into shareholder value. Conclusion: understanding these key financial terms is essential for conducting solid fundamental analysis. Whether you're a value investor, a swing trader, or a long-term holder, evaluating metrics like EPS, PE, and BVPS helps reveal the true financial standing of a business. These indicators, when used collectively, give a clearer picture of a company's performance, risk, and potential for future growth.